You don't. All right, sweet, it's working. Yay! Next time I'll title this Amar and Josh, and I'll make this.
For now, just keep it you. That's fine. This or we should call like the discussion or something.
There you go. All right, we're live now, Bubs.
For now, just keep it you. That's fine.
All right, all right.
Or we should call like the discussion or something.
There you go. All right, we're live now, Bubs. All right, cool. We are on. You still there, Amar?
I'm still here.
Okay, cool. There we go. Sweet. All right, sweet. All right, folks. So Amar and I are back. We're going to try to do this on a regular basis every day, actually. I'm not every day, every week. I had a hard time with my YouTube connection with Zoom on Wednesday, and I was basically about to pull the hair out of my head. But then we were able to get it fixed. And Scooby-Doo says, what are we discussing? We're going to share some screenshots on a potential for bear or potential for bull markets, if you will. We'll talk about that. We're going to just kind of go in some investment discussions. So we'll talk about, what we kind of see, whatever it is. I mean, who knows? I mean, no one knows, but Amar's got a nice little screenshot thing we're going to share with you. I think it'll be pretty interesting. So this is kind of last minute. We've been trying to struggle. Well, I have been trying to struggle to get this thing working, but we've got it now. So I think we got it on a regular basis, and we'll be doing this going forward for sure. So thanks, folks, for being on board here. And like I said, we'll do this on a regular basis. If you have questions that you want to address, by all means, let us know for sure. We are here to address any questions. Remember, Amar is none of this can be perceived as investment advice. I always got to say that when Amar jumps on board. Well, me too, but this is not specific to any individual, if that makes sense. Is that the disclosure, Amar? And I know you got to play it at the end, but what else, something else we got to say on that?
Yeah, this is strictly for educational purposes, I think is the key word that FINRA wants to hear. It's not taking into your personal situation or any of that good stuff in there.
Absolutely. So pretty good jobs report today, Mar. The market was up the last I saw, like 200 points or something like that. 250 was a Dow. Interesting, the 10-year treasuries dropped back to 1.72. It had hit like 1.85 the other day. So I would have thought the 10-year treasury would have been in a sell, but it's not. So any thoughts about the, we got the Dow at 27,300 almost. S&P 500 is at 3,062. That's not too shabby, huh? What do you think about all this?
Yeah, I mean, nobody has a crystal ball, right? And so, this is all good stuff. Typically, when the market goes in cycles, right, we see some of this stuff go not to a level of exuberance, but to get to these high highs, if you will, especially late market cycle. And I mean, it's good. It's good for everybody. One of the things, though, that kind of boggles my mind, right? And let me see if I can find it real quick, Josh. I have this picture. Here's my Halloween skills.
Hey, wait, show that again. You carved that?
That's me, buddy. I don't know if you can see it.
I can. Oh, that's fantastic. Man, they let you have a knife in California in which to carve that?
Don't get me started. Don't get me started.
Amar's got electricity, as you can see, so he's still Now, are you in an office or are you at your house? I'm at my house, obviously. So you got your own office there in San Diego?
No. So, when I started this business, what I wanted to do is build something that I would want my mom to have, like knowing what I know about our industry, that I would feel comfortable. I would feel comfortable my mom paying a fee for.
Yeah.
And part of that is I had to keep my costs low, right?
Yeah.
So I don't do any mailers. I don't do any seminars or dinners with, at a steak restaurant or anything like that.
Oh, man.
No mailers that says come to a retirement annuity seminar or anything like that. So all of my growth has been kind of through my existing client base, through referrals. We focus all the fees that we get from clients to be on providing the best product that's out there, right? And so part of that was until I get enough volume base that I was going to work from home. Now I have it's very rare in San Diego to have a basement. I know in the East Coast it's a big thing, but in San Diego with earthquakes and whatnot, I have a 1926 house. My house was built in 1926, and it actually has a basement. So I work out of, it's a furnished basement. It's nice and clean. It's like another bedroom, except the window is only a couple inches.
But so that's where you are right now, in your basement.
Yeah. So that's where I work. But going back to what we were talking about, this is one of the things I was pondering, is that like the U.S. economy has been in the longest economic expansion ever. Right. I mean, unemployment is sub 4% for like over a year now. Right.
Crazy.
Oil prices are lower than what they were like 6 months ago, a year ago, and so forth. The stock market is at like record highs. Out of the last, I think it's 17 years, the market has hit a new high. So 15 times out of the last 17 years, we've kept on going up in terms of the market overall.
Right.
And what bothers me, or what concerns me, is that the Fed is cutting rates again.
Yeah, that's crazy.
Now we got to keep this in granted. So like, one of the things is that if we look at all the other central banks out there, all the other central banks are cutting rates, right? So even though if the U.S. is strong, it's vibrant economy, if everybody else is cutting rates, what happens is like the dollar gets so strong that it creates these imbalances. So everything is in perspective to other countries' rates, right? So what bothers me is that we're cutting rates, number one, and then we're increasing the money supply. So we haven't, the Fed hasn't said that we're doing quantitative easing, but in the repo market, which is the bank-to-bank rates, like the overnight rate stuff, there's a lack of liquidity. And when we have a lack of liquidity, the Fed has to step in and put some money there so the banks can function, and so that you and I can go to the ATM and make sure that there's cash there. So the fact that we're reducing rates and we're not doing quantitative easing, even though we're doing it, and we're hitting all-time highs, it doesn't make sense. And from a practice standpoint, like I've, for the last 15 years, have realized that nobody knows what's going to happen. And so nobody has this crystal ball. If Josh had a crystal ball, if I had a crystal ball, I wouldn't be on YouTube right now, right? We would be being like, I don't know.
I'd be in San Diego at the beach.
At the beach, right? Yeah. And so one of the things that what we're trying to do is to focus on things that we can control, right? Yeah. So taxes, the volatility that we take, the downside exposure. So what I think about the markets, the markets are going to be what they are. I mean, nobody has a crystal ball. So as one thing that makes me nervous is reducing interest rates and injecting more money into the economy.
I think that Powell said they're going to take a break from cutting now. They're done cutting. I think.
I mean, Powell also said that like a couple months back that this is just a mid-cycle adjustment. It's not. I mean, so like I get all this analyst reports and stuff like that because I'm actually doing the investments, and I think it's like 70% of people on Wall Street think that there's going to be one more rate cut between now and then.
Even after the one yesterday?
Yeah, one more. So there's only one more left, right? But I mean, as somebody that's in the markets, if we do have a recession, right? So the markets can only go up, sideways, and down.
That's right. Exactly. Yeah.
So if it goes up, that's great. Everybody's happy. If it goes sideways, that's good too, because, if you have preferred stock or dividend interest income or dividend income, interest income, like all those different avenues provide some return. But if the market goes down and the Fed's going to try to stimulate the economy, it's going to be very difficult because there's less tools in the tool chest.
Exactly. Right? You're running out of powder.
Yeah. And we got to keep in mind that the market, it's kind of like Josh walking Pablo, right? So when Josh walks Josh pretend Josh is the economy, Pablo's the market. Pablo's going all over the place, right? And so that's what we got to keep in mind, is that like a lot of these adjustments need to be based off fundamentals, not the markets. And when the markets do go in, or if the fundamentals start to slow down, the markets are going to have this big whiplash, the volatility index or whatever you want to call it would just increase. And so what I'm trying to tell people is it's going to be bumpy, right? Because interest rates are going lower and lower, so the volatility will just get more. And to make sure that you have an emergency fund, cash.
Yes, man.
So that you don't freak out and say, "Oh, the market's down, I'm going to sell everything," or the market's, just let the market do what it does. And
well, it's funny when you say walking Pablo, because at the end of the day, we get to the ultimate destination, which is Pablo dropping a bomb next to a fire hydrant. You know what I'm saying? And me taking my thing and picking it up so I can throw it in our compost bin. That is the ultimate destination. I'm taking that little muncher out there for a walk. But like you said, he's going back and forth, and that is important, Amar, to remember what is the ultimate destination we're trying to accomplish here. I find we get over, and this is why I'm glad I don't pay much mind to it, because I literally, on a day-to-day basis, I just don't care. I mean, it literally is going to do what's going to do regardless. But I do worry about retirees with too much time on their hand, and particularly just watching the markets as if the market cares. It doesn't.
Yeah. And this is like, I actually told a client this like 2 weeks ago or so, that this is probably the worst decade to think about retirement. Just overall, like if you look at decades, sequential decades, this has got to be the worst decade for retirement. Interest rates are all-time low.
Yeah.
Increased volatility. If you go to these big firms and they use these models and they say, "Oh, you're conservative," they're putting about 80% of your portfolio in bonds, and most of those bonds are 10 to 15-year long bonds, right? So when interest rates go down and bond prices go up, that looks great, but eventually interest rates have to go up.
Well, a guy had emailed me Vanguards, and I don't know if they use this for their Monte Carlos and whatnot, Amar, but their Vanguard research shows bonds at like 2.5 to 3, stocks at 7.5, and yet they're not using that, the least that I could tell, in their own Monte Carlo analysis. So they're using what I use in my Right Capital. I use 7.5% rate of return for stocks with a 15% volatility. Bonds I use at 3%, and I can't remember what I use for volatility. But Vanguard is showing historical rates of return as if they're extrapolating going forward, and their own research doesn't. It's crazy. So going back to what you said about your assumptions, it's crazy. I find that to be scary, actually. So one guy I was talking the other day, his Vanguard stuff looked like he was hitting grand slam home runs for the Houston Astros in the bottom of the ninth, and we're still showing them fine, but it's a whole big discrepancy there, if you know what I'm saying.
Yeah. And so I mean, so I have two, I guess, issues with this. Is like the textbook models of being conservative.
Yeah, exactly. Yep.
May not apply in this situation. And most of these models where they say you can take 4% out for the rest of your life, I mean, those models were created when interest rates were 4.5 to 6.5%.
Exactly.
Right.
Yep.
And so, a lot of those models may not make as much.
And don't forget when you said about the hardest decade to retire, low interest rates. And look, I am not worried about the markets, but they aren't trading cheaply, historically speaking. I mean, no one can sit here and say the markets are cheap. They're not at a PE ratio of 8. You see what I'm saying? Like in 1982. So low interest rates, inherently high bonds, and low and high valuations. I don't believe the CAPE ratio or anything like that should scare you, but they're not cheap. Let's just put it that way. You know what I'm saying? Yeah. And real estate isn't cheap either. Just look at your house. Your mansion in San Diego. You know what I'm saying?
Yeah. Well, we have sunshine tax and everything else. But hey, let me pull up this thing that I found on LinkedIn. I think this would be cool.
So while you're doing that, we'll say, hey, Ben. Ben says Fed cuts rates because they're scared of Trump. We got Thomas calling in from Halifax, Massachusetts, and My man said Moon. I couldn't see what the first name was. It looked like Moon said emergency fund. I just real quick, Amar, that I think the emergency fund is critical. I think it's critical. If you got cash on the side, you can go to sleep at night. You know what I'm saying?
Yep. Can you see my screen there, Josh?
Yeah. Yep.
So this I'm not taking credit for it. This is not mine. It even says down here, Bespoke Investment Group and American Enterprise Investment Services. I found it online. All right, and I thought this was a good list of dividing the
bigger by chance. I don't know how to. All right, right there to the right, to the left of that, you see it. There you go. Yeah. Oh, sweet. Yeah, there you go. Sweet. Cool.
And then it blocks out.
All right, you go back. You can make it a little bit smaller from that, but
can this work?
Perfect. That's good. Yeah, that's good.
So it gives a good case for why stocks. Or so remember, stocks can either go up, sideways, or down. Yeah. Right. And so this makes a case for things going up, and for stocks going up, and this makes a case for stocks going down. Right. Yeah. And so it's a good exhaustive list here that has a lot of good stuff in it. And so do you want to go through it, or do you have thoughts?
Let me ask you a question. Do we still have high debt levels among corporations? Where's the debt level stand among, I don't know the answer. I thought that corporations got removed a lot of their debt. Are we back in heavy debt for corporate America? Do you know? I don't know.
Yeah, I believe so. So one of the things that I know we've seen directly has been buybacks, right? So because the cost of capital is so cheap, and most businesses can't find, they're putting in research and development, but they haven't found like, all right, this is where we're going to invest money to grow.
Yeah.
Essentially buying back their company stock. And I think for the last, I would say 5 to 7 years, that has been a big part of the market. Yeah.
Are they taking debt? And I don't know the answer to that. I 100% agree with that. I mean, one of the reasons the market is going up is buybacks. Are they taking on debt to do that? And again, if you don't know, it's fine. That would concern me if they're borrowing, because what concerns me, Amar, is I know there are companies who borrow to pay a dividend that their shareholders are accustomed to. That scares the hell out of me.
Yeah, and especially that's happened. Like I've seen that a lot with like real estate, right? Like there's like commercial real estate funds where they're covering their dividend payment with
by issuing debt.
Yeah.
That concerns me. And if they're issuing debt in which to buy back shares, that would concern me too. I don't know the answer to that. I just that would be something I'd want to look into some. But I mean, Amar, for me, even if that were the case, would I change my investments? No, but that would be a case for me for bear. If they don't have the cash on the side and they're borrowing, which to keep the good times rolling, that would be a huge concern to me for sure.
Yeah. I mean, I think so we can look at company financials to figure that out, but just taking like a big picture overview. Right? So why don't you make a case for bulls? I'll make a case for bears, and then we can maybe get some more questions and go from there.
All right. Well, I see valuations are fair. This is actually whoever Bespoke Investment Group, and if it's on the internet, it must be true because that's what Abe Lincoln said. He said you can trust everything you find on the internet. Remember when Abe Lincoln said that? He did a meme. He says, this guy says, or whoever, valuations are fair given current profit levels and interest rates. I actually 100% agree with that. And I talk about this a lot more on my channel. I say, look, you got the 3 big investment opportunities for most average Joes: stocks, bonds, and real estate. None of those are trading cheaply. And in fact, if you look at the 3, real estate and bonds are trading a hell of a lot more high valued than stocks are relative to future growth potential. So I agree with that 100%. You want to counter that with one of your bear market cases?
Yeah. So
and by the way, this isn't to say I'm a bull and Amar's a bear. We're just kind of
we're just taking different perspectives. Exactly. All right, so let me all right, so now if I change this like this, does that get rid of my screen?
Yeah, maybe get rid of it because I can't see if people are commenting. So maybe
Let me go back. I'm going to close this full screen.
Okay, there you go.
And then I'm going to go. All right. So I'm going to make a case here.
Okay. And while you're doing that, I'm just going to look over here and see if people are commenting.
Yeah. So we look at CEOs, right?
Right.
Average CEO of an S&P 500 company is about 5 to 7 years. We've seen earnings pressure, right? So like a lot of these companies are putting like downward projected earnings for the future, right? Mm-hmm. And most CEOs' compensation is short-term relative, right?
Yeah, hate that.
So if you need to show profitability, I mean, and you're going through high turnover of CEOs, which we've seen a couple of CEOs change, then what's the first thing that CEO will do is probably say like, well, how do I get this business profitable again? Is headcount, is looking at net headcount and see if there's any efficiencies. If people start losing their jobs, then we don't have the spending power. If we don't have spending power, then that pushes the economy. So nobody knows when there's going to be a recession. There's usually a bunch of things that lead up to a recession, and then there's one thing that breaks the camel back. That'll tip us into a recession.
Yeah.
Something that this could potentially, if we see a spike in unemployment or jobless claims, that could probably be something that says, hey, we're going to be in the bear market.
That CEO stuff, I'm surprised that 10 years that long, 5 to 7 years. I would have thought it'd been less, you know what I'm saying? But that's not good. The whole quarterly stuff has always irked me. They got to make profits for the court. I mean, that they say to us, be long-term investment, while the CEOs and the stock analysts all want quarterly stuff. It's crazy. There's a huge discrepancy there.
There's a misalignment in.
Yes, that's exactly. I'd say consumers are working and spending could fall on both sides. In fact, I didn't do a video on this, but I was in Walmart yesterday buying some almonds, which I ate on the way home, a whole freaking can of almonds on the way home. Almonds in California, so I'm helping the California economy.
Yeah, there you go. I was just about to say something.
But the interesting thing was Walmart, and this is something, Amar, the interesting to me is every time you go in any of these stores, and not just, but they're all needing employees. It's nuts. And, every single time you go to Walmart, it can be any place. They all are needing folks. And that tells me that's good, right? Because that means there's unemployment's low, but man, I don't see how inflation, I just don't see how inflation, and this is what bogs my mind about the Fed cutting. There is a huge dearth of employees, and that means they're going to have to raise wages. And on top of that, the wage growth is already accelerating over the rate of inflation anyway. Now, I don't think that's bearish on stocks. I sit there and think every time you go to these stores, there's a help wanted sign to greet you. And
we got to look at the quality of jobs that we're creating in this economy, right? Like, the jobs that pay. So there's two factors. I would say there's demographics, and the quality of jobs, right? As people tend to live longer, they'll naturally work longer. So retiring at 62, 65, I mean, even with Social Security, now it's 66 and 2/3, and it'll continue to go up to 67, right? And so I think people will stay in the workforce longer. So that means younger people that have entry-level jobs will have a harder time getting upward mobility to get better jobs, because people are not, the job that you would have taken because somebody else got a promotion, well, that person's staying in that job longer, right? So
that's
so that could
maybe, but there is age discrimination. I see, that's the thing. I hear what you're saying, but I just think at the end of the day, someone's 58 years old, they're trying to send that guy out to pasture because he's too old. You know what I'm saying? And I see what you're saying, Amar. I think these corporate guys have they don't like the old, gray beards. They want the young people because they can pay them a hell of a lot less. You know what I mean?
Yeah. Have you worked with a millennial? You got a couple of millennials in your house?
They're not. No, they're under whatever's the generation below millennials.
Oh God,
Generation
mine
Y.
are way down, but yeah. So
Actually,
like what I mean, like you're right. The workforce. So something we agree upon is the workforce is changing, right?
yes. Yeah, yeah.
Right, and so that could have factors on how long you work or how short. You know, I mean, this gig economy, which
Yeah.
a
Man.
lot of individuals are now doing contracting rather than
Or doing
being
what
at a.
you and I are doing. You and
Yeah,
I
I mean, we're part of it.
and that's see, this is I'm hoping, Amar, that you and I left good paying, low required job. When we were at USA, we didn't sweat. You know what I'm saying? We just showed up, did what you had to do, and leave, and got paid good. And we both left that voluntarily, I might add, to go into this environment, which is a risk. And I just want, and look, we're both working from home, which is freaking awesome. I just wonder, where more and more people do that. Contractor work, 1099, or just self-employed. I think that might be bullish. I don't know. We don't know. It's crazy.
Yeah, and like so I was saying, like, so with demographics, I mean, like for me, like I saw my dad work till he
Yeah.
was 64, or he passed away at 64. So like he retired at 62 and then passed away at 64. And so like for me, this contracting type work, or what we call the gig economy,
Yeah.
provides flexibility of schedule, right? So like
Yes.
when my daughters go to sleep at 8 o'clock and I know I'm going to be up for another 2 or 3 hours, I can just hop on my computer and do work, right? I don't have to physically be at
Yeah.
an office. And so,
Let me ask you a question about your dad. I mean, I'm not getting too deep, but all right. So he retired at 62.
yep,
He died 2 years later.
yep.
Did he retire at 62 because he was ill, or did he retire at 62 and he just suddenly got ill? Or if you don't mind, I'm just curious because
Yeah,
this.
no. So like, my parents saved quite a bit, and the whole. Fortunately for them, their son was a financial advisor,
Right,
right?
right.
But I think for him is that he had other passions that he wanted to pursue, right? So he didn't slow down. He didn't say, "Hey, like this is liberation. I'm done with work." Woo-hoo, right? No, he had projects and stuff that he wanted to do. Like one of the things he had a knack for architecture, right? So he was trying to build buildings and stuff like that. But no, it's and this is kind of an interesting point that a lot of us think of lifespan, right?
Yeah.
But the reality, and life insurance tables is all based off of lifespan.
Right,
But
right.
the reality from a planning perspective is that we need to take lifespan into account, but also health span.
Yeah.
So how many healthy years are we going to have?
Yeah, man.
Versus lifespan, which, because in modern medicine, I've been in the hospital, they've keeping people alive where you could make a call if that technology wasn't there, and then
Yeah.
they may not have been there. Yeah.
So because a guy sent me an article that I kind of chuckled at. He goes, if you retire early, you're more likely to get dementia. And they're looking at it back asswards or ass backwards. I was like, oh God. But anyway, but the interesting thing is that people can make a case that if your dad I'm just throwing it out there, but like if your dad didn't retire, he'd still be alive. And I said, that's silly, but
Yeah.
people kind of.
My dad had 3 kidney transplants. He had pneumonia. He had he's a couple strokes, had a couple heart attacks. He had, half a lung.
He was working too. So when he
was while he was working, right? So like think about being an accomplished person, right? Like with all these things where somebody could just like quit and be like, hey, I'm down and out. Even having all those health problems, he was able to
still be performing. Gotcha. Yeah.
Yeah.
And then at some point he said, I can't do it anymore, I guess. And then he quit the job and just
no, he wanted to spend his time more with his other projects.
Okay. Oh, yeah. I gotcha. Right on. Okay.
So yeah. So but like so like that article about dementia, like so we should maybe talk a little bit about like what do we know? Like both you and I have seen a couple thousand people retire.
Yeah.
Over our careers.
Yeah, absolutely.
So like let's say 100, 200 times. Yeah, so maybe about 4 to 10,000 between you and I, something like that, right? Because I used to be a branch manager, so I had 15 advisors underneath me. They all had about 200 clients. So, I mean,
No,
you multiply it out, right? So like, one of the things, so what are some observations? So first observation is that it takes a while to get structure after you retire.
Yeah.
It's just, if working, what to do next. You wake up, you go to work. You're busy. The busier you are, the more things that you get done, right? So,
Absolutely.
So in retirement, every day is Saturday. What do you typically do on Saturday?
Well, that's the interesting thing, especially if you use that structure, though.
Yeah, you spend money. Like, you go out to eat, you do other things, and so getting back to having structure in your life takes a while. And if you're from the military community, you thrive on structure, right? I mean, if you're going to be late, be early. And so, one of the things that I've told individuals that are contemplating retirement is to get one of those blue notebooks, and just write out what are things that you want to do when you retire. So then you can have that structure, now you have a list of things that provide some structure,
And we got a Mr. Cyclone says, coming up on 1 year, retired just under 50. He said, structure, so me is what he's saying, or I guess it's a he. And, that's the funny thing, is the same thing about being self-employed, Amar. You know what I'm saying? Like, you go into self-employment, you're like, man, I know I need to make money. I have to pay the bills. But I have all this time in which to do things. And it's hard to get, it's hard to say, okay, let's pin this down, pin that down. But when you retire, you don't have any I don't want to say you don't have any requirements so much, but you got, you literally have unlimited amount of time essentially to do anything.
And other people are like, once you retire, like you have other priorities, right? Like things happen, right? And then now you have flexibility in your schedule.
Absolutely.
And things get away from you, right? So it's I don't want to use the word discipline, but
I think there is.
Having some structure definitely does help in retirement.
Ben says he's busy all the time in retirement, always traveling and making things happen. Great life and true freedom. Now, it's funny. I think there's two trains of thought in my observations. This is, I would even say, it's empirical from my perspective. I've seen some, and I'm talking about men in particular here, but some men, they retire with seven figures in a retirement account. They say, I'm done and I'm going to quit my crappy old job. And then they get caught up in politics at Fox News or MSNBC and just get cranky. And you can actually see them just kind of decline because they're just getting, and there's studies that show this too, that retirees watch a lot more TV than they did. And I know it's sad. And then you get other people like Ben who says, man, I'm out there doing stuff like your dad, Amar, an architect. I'm building things. I'm using my head. I'm using my brains. I'm traveling. I'm doing stuff. And I would say, which road are you going to take? You're going to take the crusty old guy, get off my lawn. Or you're going to take the guy like your dad who was, until his dying day, he was doing stuff. And
so like retirement in itself is being reinvented, right? So retirement's being reinvented because of longevity, because people are in a sandwich generation where you may be retiring and your parents are still around. Heck, your parents may move back in with you.
That's right? What this guy says, Mr. Cyclone. He's taking care of his elderly folks. Exactly right. You see that all the time.
And then you may have children that graduate from college and they want to save on rent or whatever, or can't find a job. So they move back in with you.
Right?
Because, we talk about, younger generations saving, but their income from these jobs may not be as high enough to put into 401ks and such. So retirement, I definitely think, is being reinvented as we speak. But what I was going to say is that as an advisor, as somebody that does planning, Josh, right? Like part of our role is to have that conversation based off our experience to say, like, how do we make our clients next decade the best decade that they're going to have, or the next 2 or 3 decades, whatever, right? And if you don't have a plan and if you don't have purpose or you don't have intent, like, hey, these are the things I want to do, then you're not going to have that decade's not going to be the best decade that it could be, right? And accomplishing goals and so it really motivates, like financial planning, wealth planning, and all investments is great, but so I'm trying to tie this back into our investment conversation that we said we're going to have, is that so your investments need to have enough liquidity so you can take those trips, or if you find a discount on something that you have the availability of dollars to do those things. But you can also time projects, right? Like I have a friend of mine who's retired that is building a house.
Yeah.
Right? So he knows when he's going to need certain cash flows, right? And we can build a bond ladder that match that same cash flow outlay, right? And so the bonds mature, cash is there, and then now he knows what it is. So
that's actually interesting. Actually, that's a pretty interesting observation. You're timing his retirement, corresponding it with cash flow. I actually think that's interesting. That's a hell of a lot better than like you take 4% a year. No, we're saying, look, what is the purpose of retiring? What are we retiring to? You're going to build a house. Okay. So you need a construction loan, or you're going to do your own self-financing. So we need 40,000 here for your HVAC. Let's make sure that happens. It's a whole different, instead of you just take 4% a year and we'll see you next year. This actually means something to say, does that make sense, Amar? There's actually a purpose behind it.
So let me, stepping back one more step. So for me, so traditional portfolios are built off of volatility, right? So if you're conservative, that means your standard deviation is only this much that you can handle in terms of volatility. If you're aggressive, you can handle this much volatility, right? Where for me is, I think for most people, they don't look at their statements enough to understand volatility. What they understand is downside.
Yeah.
Hey, I lost, on $1 million portfolio, I lost 200,000, right? I can't sleep at night. What's going on, right? And so what I try to do is use a two-pronged approach where we have our liquidity needs, right? So like our emergency fund that we talked about earlier.
Yeah.
You have cash flow if you have plans coming up. Like, hey, if you need long-term care, right? Let's, we can build this part of your portfolio to provide some of those expenses. And then the second prong is find what's your downside hurt. Like how much money can you lose before you really become concerned? Yeah. And so I'm not really interested in the day-to-day volatility. I'm saying, where's your hurt point? So if you say on $1 million portfolio, I don't want to lose more than 200,000. So we use real dollars. We don't use percentages. So all right. So now I know on a worst case scenario, that's how much of a downside buffer I need to create in a portfolio. And then the other prong is having the liquidity. So marrying those two, you really get the right portfolio for you, right? So you got to keep in mind, again, like these models of conservative, moderate, aggressive. I mean, these are just cookie cutter models that thousands of people have. And I'll give you an example. And this is maybe me going on a rant, so stop me if I go too much. But like the moderate model has a risk score traditionally from, if you did 0 to 100, somebody that has 35 and somebody that has 65 can be in a moderate model. So you fill out a risk tolerance questionnaire and you get like 40. You're going to be in the same portfolio that somebody got 65. But we know, I mean, that's a huge range. I mean, like, so I kind of like to partition portfolios in two parts and have the liquidity part. So
that's what I call the barbell approach. Yeah, exactly. You have your aggressive, but I mean, I want to step back to even more than that, because I think I just go back to your dad, Amar, and I'm sitting there thinking, how many people are like your dad that said, this is what I'm going to do, but they, instead of being like your dad, where he focused on doing it for the last part of his life, which I guarantee made him happy, they say, no, the model doesn't speak right for me, and I can't do that. Man, and I just use this example myself all the time. She's a friend of the family, and I love her to death. And her son, actually, when we lived in Virginia, bought one of my vehicles. I had a used vehicle for sale. So just a wonderful lady. And she, her second husband, long story short, he was retired military and he had a pension and whatnot. Anyway, she was always worried, can I do it? And she wanted to take, like those Norwegian cruise things, whatever they're called, Norwegian cruises. And I said, man, just freaking do it, dude. Just do it. Quit your crappy old job and just do it. Anyway, long story short, The next summer after they did that, he died. And he wasn't in the best of shape. You know, he wasn't great. He wasn't a marathon runner. He wasn't great shape, but he wasn't, you know, freaking destitute or whatever. And she was just so glad that she was able to spend that quality time with him, even though he's only 67 when he died and she was only like 61.
Yeah.
And that really had an impact on me. And I imagine maybe even the same with you, thinking about your dad too, about, you know, how can we make this work? You see what I'm saying? Like, how can we make, you have this bunch of money up here. Screw this stupid portfolio cookie cutter stuff. You know, like you were saying, Amar, screw that stuff. This is how we're going to make it work. And if we can't, we can't. But is there a way to make this work other than just some cookie cutter approach? You know what I'm saying? And I just, our business gets so caught up in the, I don't even know what it is, the quote unquote tried and true, which isn't tried and true. And I just wish there's more real life scenarios that people would take into their planning to say, this is what I need to happen. Because if my husband dies before I had a chance to go on this Norwegian cruise, I'm going to be depressed for 30 years, even if I got money. Does that make sense?
That impacts your financial life, right? Like, right. So the difference between a good advisor and great advisor, in my opinion, is a great advisor doesn't take like, hey, I need 100,000 a year for retirement expenses.
Right.
Okay. Well, what are you going to do? How are you going to spend that money?
Right.
And they're able to partition that money into different segments that are discretionary, non-discretionary, you know, needs, wants, desires, and then making sure that those goals are accomplished. So, you know, any advisor can put you in an investment strategy, right? That's become commoditized.
Oh, yeah. Robot.
Yeah. The next level of that would be an advisor that can make you reach your goals, right? And I think like the best of the best advisors are really focused on not enlightenment, but aligning your goals with your values and making sure that you're doing the things that are valuable, how you want to spend your time, right? Because, you know, you're going back to my dad, because time is finite. I mean, nobody knows how much time they have, exactly. Right? That's the big uncertainty with financial planning, right? Do we plan to age 100? Do we plan to age 90? Do we plan to age 85, right? I mean, in my dad's case, I mean, if you take an average healthy male at age 60, you should be planning till like 82.
I mean, the minimum.
Yeah. And so like, you know, nobody knows. Nobody knows.
And the funny, well, not the funny thing, because it's real world people here.
Yeah.
But the thing that annoys me is that if you look at planning in the traditional realm, we're saying, just going back to, and I hate to I bash on the 4% rule all the time. And it's not, I'm not bashing on Bill Bengen. I'm not bashing on the Trinity study. I'm just saying it's so robotic that if you use the 4% rule, this is what works and you'll never run out of money. And I'm like, but what if you run out of time before you see, man, I'm not saying you have to be a pauper, but what if you run out of time while you're building for that 4% rule? Because don't forget, the 4% rule, you literally never run out of money according to the old methodology of the 4% rule. But on average, you could have taken 6% a year out. You said, I mean, the median was 6%. And so you're sitting there thinking, okay, 4% never run out of money, median 6%. Maybe there's something a little bit we can look more detailed specifically to some advisors saying, Amar, you need $5 million to retire. And you're like, why would I need $5 million? Because Susie Orman or the 4% rule said, you're like, dude, just get the hell out of here. It drives me up the wall because there's real lives affected here, man. There's real people's lives and satisfaction.
Yeah. And I think what the heart of what you're talking to is that you shouldn't build a plan and make it so concrete that you're just sticking with that plan. I think what we're both trying to say here is that doing planning, if you just update your plan on an annual basis, what if you have a real, like we're having this tear in the S&P 500, gone up a lot. Well, hey, now if you redo your plan with your account values up 20%,
man, right on.
It makes a huge difference.
Yeah, no, completely. Not agree more.
So you should do planning on an ongoing basis.
Let me interrupt. What software because in the software I use, if they link the accounts, this is actually a good question. When they link the accounts, the plan is fluid. You see what I'm saying? Yeah. So that way, what was you couldn't retire today, you could be just because the plan literally changes on a minute by minute basis.
Yeah.
What soft would you use e-money? Is that right?
Yeah, I use
Oh, yeah.
e-money. Yeah.
So e-money's, and I've talked about e-money before, Amar. E-money's fantastic. I'm a huge fan of e-money, but so the fluid nature of financial planning is such that if you, I talked to a lady yesterday or a guy, I said, I could print off a 120-page document, monstrosity, that'll go on your freaking counter, never to be seen again, and will be irrelevant 2 days from now because the market's changed. You know what I'm saying? Don't do that.
Yeah. So if you update your lifestyle expenses, if you want to call it, or one-off goals or your wants or desires, if the markets go up, you can spend a little bit more. The markets go down, hey, maybe we trim back a little bit. I've had clients prepay for vacations. So like you mentioned cruises, you can pay, I think, almost a year in advance and you get this huge discount.
Really? Oh man.
Yeah. I mean, so there's ways to save money, right? I mean,
or Airbnb, maybe you could do that. You can tell somebody, hey, I'm going to use your house up in Peaks Island, Maine to see where Josh is from, and I'll prepay. They'll actually have to pay you to go there. They'll say, Amar, please come to Peaks Island, Maine. We'll pay you $5,000. Actually, Maine is doing, and some place in Vermont is actually paying people to relocate to these places.
Well, they need, I mean, this is again the demographics.
No, 100% right, man. Yeah. 100%.
Do you have any questions that maybe we can answer?
Let's see. We got some, my man Alberto, who's from Orange County. Let me bring my, what's up, buddy? All right. So Alberto says the result, we got a number of people actually pretty interesting. So Ben says he's busy. Oh, we already talked about that. So Alberto says corporate America started in the late 90s, reducing aging workforce. In the early 2010s, they decided to reduce pension liabilities in both instances. They didn't consider the knowledge base. And Bob says the same thing. We're losing a lot of expertise from engineering to construction. And the reason they're doing, the issue that where that came up was when I was saying that reducing the old timers, the gray beards, for a younger hipster kind of corporate environment. I don't think that's good. Because they want to reduce salaries, they want to reduce costs, even probably health insurance costs too. You know what I'm saying? And I think that there's problems there. That one thing I will say, just while I'm yapping, if you're a 58-year-old guy and you're put out to pasture, man, what can you do? Because you have a skill set up here, and Amar, you're an engineering guy by trade. But it's not like that skill set just goes away. It's interesting, like going back to your dad. I mean, he wanted to build stuff. I don't know. It seems to me that you could take that knowledge base that you have in that noggin of yours and do, I don't know what it'd be. I don't know anything about it.
And there are a lot of websites that I've seen that pop up where you can do contract type work. Like if you have like an engineering background, like I have a client that's a landscape architect, right? There's like, he used to do it for commercial buildings like shopping malls and like, the flow of the greenery, if you want to call it, right? And in retirement, he helps people that redo their front yard. How do you make it, like a big thing in California is water efficiency. Right?
Oh, yeah.
So
so we hired someone to do our backyard like that. I mean, it wasn't that big of a deal, but we paid him money. You know what I'm saying? And he got it done.
I mean, if you get $1,000, let's just say a month from doing that, I mean, that's $12,000 a year. I mean, that takes a lot of stress off of a portfolio. I mean,
if you think you're paying between you and your spouse, let's say, Marv's better half and he are paying, let's say $600-700 a month in a Medicare B, D, and Medigap. I mean, that's that $1,000 a month for doing one job covers the whole thing. You know what I'm saying? All right. So what else we got on here? Bob says you get Boeing planes falling from the sky when you have the young folks coming in. Exactly. No real questions here. Bob says Max Kaiser I don't know who Max Kaiser is. I'm not sure if it's a YouTube guy or not. Do you have any YouTube channels that you frequent on a regular basis, Amar, that the other people might find interesting?
Not really. I mean, I'm big into triathlon.
Oh, that's right.
So on my YouTube so far is triathlon related.
You're Well, I mean, what are you doing? Are you going to run one or I don't even know
Yeah,
what it is.
so last year I did Oceanside, half Ironman, and I'm gonna do Oceanside again this year, and Santa Cruz this year in 2020. So I got two lined up.
So now that consists of running, biking, and swimming.
Yeah, so you swim 1.2, bike 56 miles, and then you run a half marathon.
Ooh, man.
Yeah.
No, that's I now. So my man Jared just wrote in, but he's from California, but he's getting ready to move to Texas or something like that. Are you going to retire in California, or is it too expensive? What do you think?
For me?
Yeah. Are you a California guy through and through, or are you like, man, I'm out of Dodge?
Yeah. Yeah, I mean, so
your wife's from Baltimore, right? Is that where she's from?
Yeah, my wife's from Baltimore.
Right.
Yeah, Reisterstown, Maryland, and so this is a good question because I know I'm going to stay in California because my mom's in California. We have infrastructure, we have family, right?
Yeah,
So
yeah.
it's hard for just like one person to get up and move to a different state, especially as parents get older and depend upon us, etc. I also find that for retirees that say, "Hey, we're going to leave California," because I wouldn't say a majority, but a good amount of my California clients have decided to retire elsewhere
Really?
because of taxes.
Yeah. So you're seeing that. I mean, I see that too, but you're seeing that as well. Being on location in California, folks are getting out of
Yeah, but two parts I'm trying to highlight here is one is that some of them have moved back.
Oh.
If I'm okay paying them, the extra taxes because I want to live my best years.
Right.
I'm happiest in California by the beach, weather, whatever you have it, family, friends, infrastructure. They know where, they know the person at the grocery store. They know the person at the coffee shop. They know where they like to get their sandwiches and so forth. Right. So that's
a big deal, man. Familiarity, community. Yeah.
I also had an experience where a client retire. They moved from California to live closer to their kids who live in Dallas, Texas, right? And then the kids get new jobs, and then they move to
California.
to California. So it's like like as your family dynamic grows, right?
Yeah.
In terms of parents.
Yeah.
You. Children that have grandchildren, I think mobility and moving from state to state becomes less of a tax conversation and more of where do you want to spend your time? Do you want to spend your time with family? Do you want to spend your time with friends? And then you're going to end up being where they are.
She says she's going to retire in California once the mortgage gets paid off, but she says the only problem is taxes. And I want to real quick. Look, I don't like California politics. I don't make that. I don't hide away from that. I think it's nuts. But at the end of the day, taxes in retirement are not the problem in California. It's Amar. So many. It's like same thing with people in Maryland. I got to get out of Maryland because of taxes. Income taxes in retirement for each individual state aren't a problem. It's the property tax for sure. California's got other issues, but the income taxes, Denise, is just the income tax. And I don't know what your situation is, but I'm telling you right now, I've run so many plans for people in California, and the income taxes aren't the issue. Now, if you're making over six figures, maybe. Most people I talk to, they got Social Security, maybe a pension, and some 401k money, and they're fine tax-wise. So don't up and leave California because you think the taxes are the issue. They're just not. It's just not.
Yeah, I mean, I've found people that have left California to go to like Texas.
Yeah.
Property taxes are more than what their total tax payment was in California.
Yep.
And I mean, now cost of living is slightly different, right? But
hell, you're in San Diego. I memean, you can't freaking get a tent without paying $400,000 out there.
Yeah. But I meant to. So after your core, housing and all that. Activities,
Yeah. Jerry says it's the day-to-day taxes that make it black. No, I was listening to a lady called a Prepper Princess today, and she's leaving California, and she was talking about about the tax, like just the lack of, she couldn't, now I don't know where she was, but anyway, she was saying just the regulations on her being able to use her house, her land for what she wanted to do. But she was making a point that is the overburden of regulation in some districts of California that make it problematic.
And I think, I mean, we're picking on California
Yeah.
because it's all over the press right now, but I feel like it's a pendulum, right? It goes both ways. And
you could be in Florida, you're going to have your HOA.
yeah.
Don't do a fence in your H. I mean, you could be, if you have an HOA, trust me, all these guys want to be controlling of other people's lives. Amar, we've been coming up on an hour. All right, so folks, while we're here,
let me play my disclosure.
Yes, play it real quick. And then I want to close up. Yeah, absolutely.
Yeah. So I got to play this disclosure.
Pablo will say hello. So go ahead, so that way people can look at him while they're hearing your.
And let me know if you can hear this. Ready? I'm hitting play right now. I thought I was.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Client First Capital LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital LLC unless a client service agreement is in place.
Right.
Sorry, Josh. So this is important for people to understand is that because I'm in the business, I'm regulated,
right.
and I have to have this disclosure, and
everybody gets it, Amar. Everybody gets it. All right, so what we're going to try to do is we're going to try to do this on a regular basis, like Wednesday, and again, Mars, California time, at noon on Wednesdays. So just keep your eyes and ears peeled for that, at noon Eastern time. And then if we have to go to 1 or something like that because Amar hasn't got out of bed yet. Oh, by the way, the person reading the disclosure, that was Amar's daughter. That's how smart she is. She can read that disclosure. How old are your girls again? Like 4
2 and 4. 2 and 4. 2 and 4.
Yeah, that's what I said. 2 and 4, right on. So that's how smart she is. Anyway, and so we're going to do this on a regular basis. And Amar is, I don't want to say the investment guy because he does financial planning, but he has tools and stuff that are more geared towards investments than I do. And so we can't talk specific, like you should buy that or buy this. However, for investment stuff, and I don't want to just pigeonhole Amar as the investment guy, but when we talk, because I don't talk that much about investments, Amar, I talk big picture stuff, but not, in terms of, it's just, I'm just asking people if they have questions on various things that we want to look up, we can absolutely not give you advice on this, but we can certainly look up things like, if you're looking at, go ahead.
Yeah. And I think it'll make these video chats better for everybody if we have some content that we can prepare.
Yes.
Exactly. If people can tell us like, hey, I'm interested in just the other day, Josh, with the 2017 Job Tax Cut Act, I'm messing that up. Right. Yeah. But, it's, if you put money into beyond the max that you do in your 401k, you can put in the after-tax piece. That after-tax piece can now officially go into a Roth IRA when you retire, right? So maybe that could be something that we talk about is, we always talk about like the backdoor Roth, right?
Yeah.
Where you go and put a non-deductible IRA and convert it to a Roth IRA. We should call this like the mega Roth or the superstar Roth because you could put a lot of money in after tax, and I think that would be valuable. So,
absolutely.
Maybe for our next call, we can pull up some sheets on that, and then we'll go from there.
All right, man. Good stuff. Thanks for being here, guys. I have to make a taco run, says Ben. I gotta go. I gotta call myself at 5, and then I gotta go give this monkey a poop break, as we talked about chasing Pablo down the street. But Mar, thanks for being here. Thanks for being here, y'all. And Mr. Cyclone says he loves the channel. Muchos gracias, as we say in Pablo's homeland, because Pablo, he's from Mexico, not really, but we have a real quick, Amar. We have a girl across the street who says Pablo could only understand Spanish because his name was Pablo. She is a little girl. It's the cutest thing ever. Yeah. All right. So Denise says she'd love to hear about that mega, not the backdoor Roth, but the mega Roth. So we'll definitely talk about that next time. All right. So this is, we're going to sign off here. I'm going to stop recording and I'm going to stop live here. Amar.